Hello, welcome back to The Financial Operator. I am your host, Jen Pfizer, owner of MKB CFO and Bookkeeping. Today, I'm here with Sonny Grappone, and he is also a fractional CFO. So I'm excited for our conversation here. Hopefully, we will drop a lot of really good insights and help business owners with whatever they may need. So first of all, welcome, Sonny. Thanks for being on the show.
Thank you so much for having me, Jen.
Thanks. Okay, so tell me about yourself.
Yeah, sure. So, as you alluded to, I'm Sonny Grappone. I've owned Precision Accounting Consulting now for going on 5 years. Before that, I was in corporate accounting. I'm from Long Island, New York, if you couldn't tell from my accent. I worked a number of years in corporate accounting. My first job out of school was, Northwell Health. That was like about 15 years ago. I went to school kind of late, probably when I was about 20, I want to say 25, I went back. Like a, dumb kid when I was younger. I had no idea what I wanted to do. Not saying I was dumb, but, I made a lot of mistakes when I was younger, with the back and forth of taking classes, dropping out a semester, and to be honest with you, I always had that entrepreneurial mindset where I just wanted to make money. And I didn't care what I had to do to get it. I went from mopping floors to, working at Three World Trade, so I've done it all from that standpoint. And, I think my humble beginnings definitely allowed me to progress into the business owner that I am today because of that work ethic that was instilled in me. And I owe that to my family, especially my mother. I come from my mother came from a third world country, Guyana. She came here with nothing and basically lived the American dream. She worked hard at a company, worked her way up as a bookkeeper at a big supermarket chain, and was able to make enough money and finally move us out to Long Island, New York, where I grew up in Levittown. And Levittown, New York, Long Island is like probably one of the most expensive areas you could live in, like in the United States. Back then, you were able to work at a supermarket and have a full-time job, get benefits, and be able to afford a house out in like neighborhoods like that. You can't do that nowadays, but I was fortunate enough where my mother was able to do that. And, I was able to come here and kind of revamp my life. I came here like 13, 14 years old. And my first job when I moved out here was bagging groceries for my mother and my father at their supermarket. So I would go there, put a little tip jar out. I'd make like $75, $100 in a day, which was great back then. And, and that's where I kind of started getting that mindset of starting to make my own money and really like the feeling of it. And I progressed into entrepreneurship as I got older. Like I said, when I was in college, I went back and forth. I had a real act for cars, auto detailing and auto body. It was a hobby of mine, and I still do it to this day, but not as much as I did back then. And I turned it into a business. It was my first real business. And but after doing it for a number of years, I started to get a lot of wear and tear on my body. And I had like a kind of a rude awakening and saying, I don't know if I could do this for the rest of my life. And my mother's dream was always for me to go back to school. And so I kind of put my big boy pants on and I moved back home. I moved out when I was 18 and I moved back when I was 25. And I had to live at home in a little, probably the size of my office, an 8x8 room for 5-6 years while I went back to school and full time and kind of gave it my all. Because it was either that or go part time and pay rent, which I didn't want to do. And it took me 5 years to get my degree after some, trials and tribulations. And I progressed to Northwell Health, like I was alluding to. It was like a non-for-profit hospital, right? I hated it after probably about a year. I left there. It was just, what it was. I didn't get enough guidance and I wasn't learning the real accounting realm. Mm-hmm. And it was a bunch of monthly meetings where you had to present variance analysis. For anyone who doesn't know what a variance analysis is, it's basically, comparing, prior year comparisons of your business or quarterly comparisons of your businesses, going line by line and saying, this month it was this much this month, now this quarter it's this much. The difference is, what it is, and you have to explain that difference, and their variances were very tight where you had to explain, like, if it was off by 0.2%, you had to find the answer for that, and if you didn't, you were in trouble. Like, so like, and I had like a dragon lady for a boss. So, and I wasn't learning a lot because in corporate accounting and that type of field, when you're working for these big corporations, you're working on one line of the P&L. You're not even like getting your hands in like the whole nitty gritty, so, and you're basically becoming like a computer programmer, like learning how to like upload macros, like, where the software does everything for you. So I went into consulting after that, and I was able to get my feet wet in a bunch of different companies in Manhattan. And that was great exposure for me. But the same thing, I was working at Cantor Fitzgerald, which was a very big firm back in the day, still is. And I worked at 3 World Trade, where I worked at an algorithm trading firm where I was doing, I was in their accounts payable department. It was great exposure. And I had a bunch of different jobs. And finally, I came to a realization I wasn't happy still. Like, I just wasn't getting that fulfillment that I wanted. And I was changing as a person. When you work in Manhattan, it's not 9 to 5. You're spending 4 hours of your day commuting, which is like terrible. And you're just nasty, because you're always in a rush, to catch a train, get home, do it all over again. And I remember talking to my wife at the time. We just bought our house. So we were like 6 months in. And here I am telling her, like, I think I'm going to quit, And, luckily I had a guy that reached out to me that I consulted for on the island, and he was trying to poach me. And I said, this guy's been poaching me. I really like him. I really have a good vibe about him, but I'm not going to get paid the same. I'm going to have to take less money. And my wife supported me. I took less money. I sacrificed my sanity, and I came to work for him. And he owned a hospitality accounting firm where he worked with hotels, restaurants, you name it. And, and he told me, he goes, I promise you will learn more in this line of work than you will ever learn, than you ever did. And you'll pass, 7 years in public accounting. I said, all right. I said, I believe you. And so I came and I worked for him, and I did. He put my feet to the fire, and, you get your hands on the balance sheet, the P&L, cash flow statements. And I got my hands in everything. And I was like, this is like unbelievable. Just, and to have that power of like, not even more power, but just like, you're really bringing value to business owners. You're involved in the everyday decisions on, what's transpiring and how they're going to make it through, month to month, and budgeting and, really planning ahead for them. So I really like that aspect of it. And, so finally my boss at the time was telling us, listen, if you ever were going to go out there and get some business for the company, I'll make it worth your while. And I took that initiative. I really, I always thought outside the box. And so I took it upon myself. I did some promoting on my own. And eventually, I would say the second year working for him, I brought in enough business where I was able to dictate my own terms, where I made him a partner in my own company. I always had my side company, Precision Accounting, in the background, where I always did side bookkeeping, minor CFO work, that type of stuff. But I needed someone else to kind of lift it off, and give me some infrastructure, an office, that type of stuff, some clientele, So I wanted to bring some of the clients I was bringing to him into this new business and split it 50-50. And he agreed, and it was the best thing that ever happened to me. And finally, after that, it just took off. And, 3 years later, 5 years later now, we're doing very well. We have, a number of clients in very different industries, and we have our hands in a lot of different buckets in consulting, accounting, CFO work. We do outsourced AP. We have our hands in a lot of different buckets, but I couldn't be happier. So, that's kind of me, in a 10-minute nutshell of how I got here.
That's great. And there's one thing in there that you kind of touched on that I think is really important for small business owners to understand, is that what I heard you say through a lot of that, like, not all accountants are created equal, and not that one is better than the other. But if you are a small business, I was talking to a guy earlier on a call today, and he was like, oh, I have this friend, she worked at KPMG and she was, in the audit department. And he was like, I'm going to have her look at my books. And I'm like, you can do that, but I don't know that you will necessarily get the value out of it that you think you're going to get out of it, because unless that person is really looking at a business, at like an overall business and how it makes money, not just whether the thing, are they categorized in the right transactions categorized correctly? Like, how does all of these pieces work together? Your reporting and all of the different facets of business. Like, some accountants have that knowledge. Others are really good at taxes. Others are really good at, like you said, looking at one single line item on a report and telling you whether it's good or not. But you want somebody that's got that experience. If you're a small business looking for like an all-encompassing CFO, bookkeeper, whatever it is, make sure you get the right kind of accountant.
It's so funny. Auditors, they have a very hard time once you're in auditing, and if you stay in auditing past the 2-year mark, right? Because people in accounting, right, they have to do 2 years of auditing, especially in public accounting, in order to get past that. They work at KPMG, right, Price Waterhouse, all these other firms. And I've hired a few auditors, in the past, and they can't get past that auditing view, like to think outside that box and look at the whole picture. And these are people that are looking at, mind you, multi-million-dollar Fortune 500 companies. So they have a different mindset as opposed to when they're going to look at your business. Not saying it's anything small or anything, but they're not going to know exactly what to look for. Just in my experience, but that's what I've seen with auditing. They have a very hard time taking that cap off and thinking as a regular accountant.
Yeah. And I see that with taxes too, right? And you probably see the same. Like, somebody will hire a tax accountant and then they're like, well, they're not telling me if I'm profitable or not. They're not telling me if my strategy is correct. There's like all of these other questions that they think that their accountant should be answering for them, that it's not. But it's like, from the accountant's perspective, they're like, I just filed your tax return, dude. Like, I'm not involved in your business. So when you're looking for a CFO or a bookkeeper or a CPA, whatever it is, like, make sure that you're finding the one that fits your business and what you actually are wanting from that person, rather than like trying to do it the other way. But
I see so many business owners. It's funny because a lot of them too is they think of a bookkeeper or an accountant or a controller, whatever it may be. Just get my books done so I can do my taxes. You either have one or two people that come to you. You either have that, where I just want a bookkeeper to do my so during tax time I know what I owe, or you have the other that's just, that wants to focus on that profitability, to know what's going on their net income, or, whether, what's draining them down. Is it payroll? Is there a cost of goods sold? What are the stuff I should be looking at? How the balance sheet looks, I always find that a lot of the books I inherit, everybody avoids the balance sheet. Like, it's like a bad word. They don't want to look at it,
Mm-hmm.
and it's the worst thing you can do, because, right, a P&L month after month, it doesn't roll forward. A balance sheet does, right? So that balance is and it has huge tax implications. If you are not watching those balances, they affect your basis, right, in your company, your equity, right, your retained earnings. This is just stuff that business owners, they don't have the proper education, nor should they, but they need someone in order to kind of paint by numbers for them, and say, this is how it's going to affect you in the long run in your bottom line. Just things that business owners should be aware of.
You probably see it a lot too. Yes, during tax time, everybody's not everybody, but your tax accountant's going to look at your balance sheet. But a lot of times when somebody is going to get a loan, that may be the first time that they've ever even looked at their balance sheet or considered that it needs to be correct, right? Like, they're turning in their balance sheet to their banker, and they're like, it shows that you got $4 million in loans. And they're like, I don't have $4 million in loans,
Yes.
So reviewing that to make sure that the things on there are correct, because a balance sheet should, like, at the end of the month, it should show you your loan balances as like actual correct numbers, not just these made up numbers. Owner's draws, things like that are, those are going to have some major tax implications for you.
Your assets,
so those are things, like you need to be reviewing
depreciation, make sure that you're capitalizing. I see sometimes in people's P&Ls, I'll see people that leave like $20,000 expenses. All of a sudden, what I like to do, right, is, to see if there's anomalies going on a person's books. I'll run a, year-to-date P&L, have it broken out by month, so you could kind of do a trend analysis, right? That's how you're going to be able to see kind of what's going on and what's off, and kind of what the factors are. And sometimes you'll see these huge expenses just, right in the middle, of your P&L. And I drill into it and I see what this is. And it's a repair and maintenance or something like that for like 20, 30 grand. And like when you look deeper, it's like you should be writing this off. You should be capitalizing this, and depreciating it over the course, depending on what it is. But there's just a lot of room there where you can kind of play with in order to kind of improve your bottom line, depending on what you're looking at. And it's so funny you say that with the balance sheet with the loans. I can't tell you how many people with their loans that they had no idea either that they had a loan, right? When we've been seeing this a lot lately because nobody's been paying attention to it, the SBA loans, right? The SBA loans that a lot of people took out during the pandemic. I think it just started happening now. Like I think 36 months, or I forget what the timeline was that they had to start paying back. And I had clients that came to us and, said like, my account never warned us about this, and now I'm getting letters from the Treasury Department, and I'm looking at the balance sheet, and they just have this loan balance that's just staying dry and nobody questioning it. And I'm like, why wouldn't anybody ask you, especially at the end of the year? Okay, I get it. Month to month, you're busy, you want to get your clothes, but like year end, when you're tying out everything, like these are the questions you have to be asking. Is this loan valid? And if it's not, then what's going on with it? And the people that put those SBA loans to the side, mind you, the first, I think, 18 months is all interest. It's not even principal. So that's going to get tacked on even more. We found that out with the loans also is during PPP. A lot of people needed PPP and they came to us because they got turned down by banks because their books were terrible. And then we're looking at their balance sheets. I had one client, all right, we took them over. They were using QuickBooks to print checks. Okay, that's what they were doing. They would print checks from QuickBooks, okay, and then they would keep a number of checks in their drawer, okay, and have them predated. That way, when the owner came in and they need to pay a bill, they could just pull a check from the drawer, have them sign it, and then they could send it off. So their book balances were I'm talking minus $20 million. It took us probably about 8 months. What I had to do was, because it was such a mess from years and years forward, and I was asking their tax accounts, what's going on here? What am I doing with these balances? They had their own sets of books they were going by. They weren't even going by their books. So I had to create new GL accounts from May 1st, because that's when they started with us, and going forward. And that was my balance, and before May 1st, we kind of had to create a plug or, kind of make some hard decisions on where this was going to go. But overall, it affected the tax liability because we had no idea what we were doing with these balances, right? Because when stuff is out of balance on the balance sheet, it's only going to go one or two directions. It's either going to go offset something else, like it's either going to be your liability is going to offset your asset, that something needs to kind of come together, which a lot of times doesn't happen, or it's going to have to go on your P&L, and it's either going to create more of a profit or more of a expense. We just had a guy that we have a client, he had a cash balance. He owns a restaurant. He takes in cash every day for this restaurant, right? So on the balance sheet, we have a cash clearing account, right? So basically his cash comes in, right? So it's basically, debit cash, credit, credit sales, right? So this is in order for us to reconcile cash and make sure nobody's stealing, right? So at the end of the month, we see this huge cash balance each month of $20,000. Then the next month it's growing and growing and growing. And what that's indicating for business owners is that, why is your cash balance is saying 20,000? Do you have $20,000 sitting in your safe right now? that you didn't deposit? And most of the time they'll tell you no. So long story short, at the end of the year, he had $90,000 of undeposited cash on the balance sheet. And I'm looking at this and I'm like, what happened to all this cash? And his guy couldn't tell me, nobody. And he's like, oh, you know what happened? At the beginning of the year, I was taking cash and I was paying for rent and paying for certain expenses. I'm like, okay, so now, you know what's going to happen to that cash? I got to reduce that account. And the other side of that is going to have to go on your P&L. And you're going to, you know, it's going to affect what you thought your net income was now and what you were profitable. It's really not, you know, and, you know, so those are just the implications, you know.
Yeah, but that's an important one too, because that's one of those things, especially if it happens to be a business owner that is looking at their profit and loss each month and they're like, oh, I'm profitable. I see this happening a lot with like bookkeepers or tax accountants. They'll go in once a year and do all of their journal entries in December, right?
They just look everything together.
Yes, that is. So you're like, oh, everything looks great. And then it's like hammer down on December where you're like, oh, I lost $1 million in 1 month. How did that happen? But it makes it really hard to actually be able to identify where your problems are if you're only reconciling things once a year.
Yes.
Because, yeah, right? Like, how are you going to know where your actual problem originates from?
It's a terrible practice. I do everything month to month, right? And like, you know, what I'll do is, like I told you, like, you know, I'll do like prior month comparison, which I like to do. A lot of people like to do prior year comparison, but I like to do prior month comparison because that really tells me a lot of what's happening month to month. You know, so you could see like, okay, you know, if I'm $40,000 profitable this month, you know, and my profit went down, you know, say 30 grand, why is that? You're not going to be able to look at your P&L and kind of tell right away. You know, you do a month-to-month comparison and kind of do like a percentage change on the side, you know, and that will show you some big variances that are going on. Like, you know, oh, you know what, my payroll went up. I'll tell you a funny story. I had a guy that didn't have his hand on the pulse, and his accountant was doing the same thing. Year end, doing all his journal entries, right? He was never making a profit. And he was a physical therapist. Okay. He started in 2019 all the way up to 2025. He went from $1 million his first year, $3 million the second year, $5 million the third year. Now he's at 7.5 million. Okay. So he went from 7.5 million last year. Then to this year, he went to same thing, same revenue, 7.5 million. So I'm looking at the numbers. This is when we take them on. I'm looking at the numbers. I see, okay, you had the same revenue. Okay. Same expenses. COGS are the same, right? And I keep going down the list. His net profit went down by like almost, I don't know, I want to say 500 grand. Okay. And I'm like, why? I said, he did the same revenue. I said, he's got the same COGS. I'm looking at everything. His payroll went up about 340,000. for the year. He has a heavy payroll. Okay. So mind you, he's got about 7 million, 8 million in revenue. He's probably does about, like, I would say 4 to 5 million in payroll. You know, that's a lot of his expenses are all in payroll. So I'm looking at this and I'm like, your payroll went up 500,000. You did the same revenue. Why? Like, he couldn't answer me. He's like, I have no idea, you know, and I'm looking into it and I start digging into his payroll reports. I start drilling into everything. And I'm like, you're paying this guy overtime. I said, you paid a ton of overtime this year. I said, you're even aware of that? And he goes, no. And he goes, I said, something changed with your benefits. You decided to pay health insurance? He said, yeah. I said, you're paying 90% of their health insurance? He said, yeah, I thought it would be a good perk. I said, you can't afford to do that. I said, I said, their health insurance is enormous. I said, between the overtime, the health insurance, and there was a couple of other things that he wasn't keeping an eye on. You know, his therapist, one thing I was looking at is he pays a therapist $90,000 a year, okay, or $100,000 a year. What are they taking care of on a monthly basis of patients? Are they billing that much? You know, are they taking in $90,000 a year in patients? No. You know, they're all, half his people were operating at a loss when I started doing the numbers, you know. So like, this is like the CFO type of like level of work that, and, you know, finally after that, all that, you know, we drilled into the numbers. I told him where he had to make his cuts. Finally, it took like 6 months And now at the end of the year, he's in the green. He actually made a profit this year. He made a profit of, I want to say $250,000. It's something, but he never made money in the last 6 or 7 years. But this is the type of like level of accounting that he needed. And I advise strongly business owners that don't do it, that they just looking for tax time. You're operating the wrong way.
Mm-hmm. Yeah, that's something that you need to, and just in general, to run your business profitably, like you need to be looking at your numbers. And I see it a lot too. You probably do too. Like if somebody's bank account is going up or down, like that's basically how they judge whether they're making a profit or not.
I say this all the time. They think if I can make payroll, okay, if I can make payroll and I can pay myself, I'm profitable. I'm doing okay. I'm like, that is the furthest thing from the truth. And when you're coming to me, when you can stop paying yourself, that's when you're coming to me, because they never come to you when things are going right. They're coming to you when things are wrong, and they always say, well, I don't know what happened. I can't pay myself the same salary, or I can't pay my guys. It's like, yeah, because and they can't tell the difference between a book balance and a bank balance also, which is a very, strong indicator that you have to have your eye on these things to know your income and expenses, for the month, and how to allocate that cash flow in order to, have a living sustainable wage, for yourself. But it's so true. I just laughed when you said that, because I say that all the time.
Well, and I say it because when I'm talking to clients, it's like, I have seen a lot. I know you've seen a lot too, right? Like you've seen a lot. You've seen a lot of things done wrong. You've seen a lot of craziness probably going on in businesses that is like, you cannot surprise me. Like I've seen it all. I've seen probably worse than, whatever you're going to bring to me, I have seen worse. So like, don't ever feel ashamed of whatever you're going to bring to me. But like same thing, right? Like you've always got a story about how it could have been worse, or how you've seen somebody doing it worse. I've probably done things worse. So, it's like no judgment here from a CFO.
Oh, what are you kidding me? I mean, you think like just taking in like my own work, like I'm the accountant in the family. My wife handles all the expenses. I mean, just figure that one out, because like I don't even want to, I spend all day doing everybody else's books, but when it comes to my own expenses, sometimes, I'm terrible at it sometimes, I just, if I was really smart, I would, which listen, I think I am, but like, just building a budget and doing all these type of things that, but my wife is very good with the money. I can't say anything to that, but I've seen it all when it comes to businesses that have, made terrible decisions, cash wise, and they're too proud either to kind of come up and say like, I've got a problem, this is what it is. Or a lot of times they're not even aware of the problem, and they just keep it going and going and going until eventually, you're going to reach a point where you're going to have to make some hard decisions, of, paying yourself less, or, letting go of some payroll, some staff, or closing down a location. I say that in kind of the restaurant world. But the other world that I'm very heavily involved in is also construction. That's like the field that I'm very passionate about. And one of the things that I do very well for a lot of our clients is we just do strictly job costing for them, right? They have a lot of construction clients. They're, I would say, Markham did a study on the construction industry. They're very heavily involved in the construction accounting field, cost accounting, that type of stuff. And they did a case study on technology with construction companies and how far they are behind, in technology. The average construction company is 10 to 15 years behind on technology, which is like massive in today's day and age. Like, can you imagine being 10 to 15 years behind technology in 2026? Like, we're talking like that's ancient nowadays, how fast we're progressing with AI and everything that's happening, so they don't utilize the tools. Like, I've had some construction clients that still do pen to paper, it really like, and I was talking about it with a guy yesterday, actually, an employee for a law firm that I handle their accounting for. We do CFO work for him, and his payroll and his 401k, his IRA, the calculations have been off of what they've been taking out, right? And a lot of this is manual work that we're doing because a lot of it's not automated. Because stuff just doesn't go together. His payroll system doesn't do it. And that's why I say all the time, automate as much as you can. And then, that way you can review listen, it's not perfect, right? Automate does black and white. That's the way AI and automate, maybe they'll get past that in the future, but right now it's very black and white. That's why you need a human there to intervene, because businesses aren't black and white. But the reason I say that is, because you can't rely on manual work. There's just so much room for error there. There really is. I don't care how perfect you are, how your Excel sheets are, how your formula, like automation is the future of this industry. And it could do what took me 4 hours at one point now takes me an hour to do, with systems in place. And that's what I bring to the construction industry for these gentlemen. I try not to overwhelm them. I really don't. You gotta crawl before you walk, kind of ordeal. But a lot of these construction owners, the main thing, the reason I said I want to get into job costing with them and provide them with this service is the people I've met on calls, like, lead calls, clients that I'm trying to sell to, I would say 70% of contractors have no idea how much they're making off each job, off each project. Mm-hmm. When you ask them, they tell you point blank, I have no idea how much I'm making off each project. And it's not their fault. It's because they don't have the rights. They don't have the bandwidth in their staff to take on that workload, because it is a workload. You have to have it's all about data and incorporating the data incorrectly into your software. And it starts at like you're as simple as your vendors, right? Making sure that your vendors, when they're giving you purchase orders, that they're purchasing out to the project, not actually to the contractor, right? That everything has a cost code. It's a lot of work in the beginning. I've done my investigating on software and, implementations that automate all this stuff. And it took me a while. It took me, I would say, a good year to find the right one. And I finally did. So I've come in now on the back office and say, listen, you don't have to switch your accounts. You don't have to take anybody out of what they're doing. Keep them where they are if you're comfortable with them. And I'll just handle your job costing for you. And I guarantee you, when this is all said and done, I will increase your profit margins anywhere from 10 to 30%, depending on what type of industry you're on. Because just so like a business owner, which some of them know, but some of them don't, right? Construction industry, for example, you're lucky if your profit margins are anywhere from 10 to 15%, right? And when I say that, just for an education, right, for a business owner, right? You start off with your revenue, right? And your purchases, your cost of goods sold, usually that should run anywhere from 25 to 30%, right? Okay, of your revenue. Then you have payroll, which runs anywhere, today's day and age, it could run from 35 to 50%, I've seen, right? Even more. Okay, so right there, say 30 to 40, you're already at 70%. 30% you have left, right? You have rent, right? You have G&A, right? Your general and admin expenses, insurance costs, right? That's probably going to eat up about 10 to 15% right there. You're left with 15%, right? 10 to 50% profit margin. That's very, very slim and tight to operate on, right? So like bringing in the tools like this, like job costing, to show you, okay, this is how much you're making off each project on your expenses, and making sure your labor is tied out to all your projects, right? And now you could see, like, I've had job costing clients that came and said, I've been doing this type of field work in these industries, and I had no idea they weren't profitable. And I see that these ones are extremely profitable, and I don't do enough of them, and like at the end of it, it takes a little bit, like I said, 6 months to a year, but all of a sudden that following year, their profit margins are increasing because they're making the cuts where they need to, and really, kind of narrowing down, getting to the granular level of the expenses. And it's added tremendous value for our clients.
Mm-hmm. Do you see this too? I was talking to a client last week or the week before, and so when they were bidding a job, they were estimating something at, however many hours that they were doing. And they were thinking that they were shooting for 30% margins. That's what they wanted to net margins.
Okay.
And so, but what happened was they were bidding jobs. They were including X amount of labor hours. But every single job they were going over. So every job was not as like on paper. They thought that they were like estimating things at, a good profit. And then by the time that they got to by the time it got to their bank account and everything's washed out, they were like barely, I think they were ending up at like 4% net profit.
It's crazy.
But it happens a lot, right? Like it's like they think ahead of it. They're like, oh, I'm doing this right. I'm planning, I'm doing all of this bidding and estimating at the correct margins and all of that. But then they're not watching it on the back end. No. So it's like they're putting it out on the front end, like, okay, this is good. But then they're not making sure that their guys are, not wasting time or, all of these things that go into it that affect your profitability. They really affect your profitability. Ooh. Or they let people, like your point, the overtime, that can get out of hand really quickly, right?
Well, yeah. And listen, when it comes down to estimates versus actuals, right? Because that's what's transpiring here, right? You have your estimates, right? And then versus your actuals of what transpired, right? And like the perfect way you do it, like say if like you're a contractor, right? And you're working on like you're a union contractor, you're working on for the town or doing municipalities, okay? And say, oh, I did this job for the town of whatever, and it cost me this much, all right? So I'm going to estimate that it's going to cost me the same amount this time. You would think you would be spot on, and their estimates are exactly what we call it, estimates, right? They are not even close to actuals. That's why when you do proper job costing, I'm not even tooting our own horn. We are like so close to the penny, and we've shown case studies to them and like kind of like, the variance of how much we've been off. But you know what else that indicates is that a huge thing that people don't realize that can bankrupt, especially a startup, right? I've seen this a lot with startup companies in the construction industry, is their insurance, okay? Their insurance, their general liability, all right, and their workers' comp is a huge burden, right? It's a tremendous amount of money for these guys, right? But what happens is when you ask them, right, how are you bidding your workers' comp and your general liability insurance into your jobs? And they look at me like I have 5 heads. I'm like, aren't you taking that into consideration? Like, when you're bidding a job and you have all the stuff that you have to put out, right? Materials, payroll, this is all the stuff. Aren't you putting insurance in those line items that you have to account for? They go, no, I just pay. I said, so how are you paying for that? Well, I don't know. At the end of the year, out of my, when the bill comes, that's when I'm paying it. So you're basically telling me you're paying it out of profit. They're like, yeah. They're like, but you need to bill for that in order to make up for that. They're like, so they never even think of these things, okay? Because what happens is workers' comp, for example, and general liability, when you get a quote, right, it's based off payroll, right? So they're going to say, we're going to give you a workers' comp quote, right? What do you estimate your payroll to be? I think $400,000 for the year. Okay, so that's what we're going to put it at. That's what your rates are going to be. Fine. And then all of a sudden, the year comes, their payroll, like you were just alluding to, skyrockets. Okay, now their payroll is $800,000. End of the year comes, right? They don't do it at the end of the year, though. They do it at April, usually, a lot of these insurance companies, right? April comes, they give you the audit notice. You said your payroll is $400,000. It's really $800,000. Now you owe us, I don't know, $100,000, in the audit fees. And you owe us also for underestimating for the new policy for the 4 months that we're into for the new policy. You also owe us for those 4 months. This, I've seen it bankrupt contractors because they're like, where am I getting this money from? Like, how am I doing this? They have no idea. And there's 2 solutions to that, right? One is to know your payroll, right? Get that dialed in, right? And as it's increasing, you have to know, okay, in the next job, I have to make sure I make up for this workers' comp to make sure that I'm meeting the standards because I'm going to get that end of the year bill. And then 2, they have a program for people so they don't have to run into these problems, which is called pay-as-you-go insurance, right? I don't know if people have heard of it, but right, a lot of these companies and brokers won't tell you about it because the reason brokers won't tell you about it is because they make more off direct bill, meaning that just give me the regular policy. Pay-as-you-go, they get paid monthly. But pay-as-you-go is such a great solution, and whoever your carrier is and your payroll company, they will do it for you, okay? And it's a minimal cost. And what they'll do is they'll hook up your insurance carrier and connect it to your payroll company, and they will debit your workers' comp each payroll period to make sure that it's entirely accurate, because now they're going to be current. It's not off an estimate. It's off your actual payroll as it's transpiring every week or bi-weekly. So these are like solutions that you could get around so you're not digging yourself in a hole when you're getting these estimates so way off. But how do people know? By listening to people like me and you, right? And getting an education in it.
Yeah. Listening to people that have seen that happen in bankrupt businesses.
Yes.
To your point too, another thing is like payroll taxes. I will see where they I've seen a lot of companies that will, when they're doing an estimate, they will take the direct labor, like whatever it is you pay this guy to go out and do this job, that's what they're putting in their direct labor, estimate there. Sure. And I'm like, you got to build in, payroll taxes first of all, but don't just take, the $20 that you're paying this guy and multiply that by the number of hours that you're estimating to do the job. You need to build in all of those extra costs.
Yes,
that are tied to that, right? Because
100%.
If you don't take your payroll tax, if you don't add that onto it, I mean, that's what 7.5% right off the top. Your profit.
A huge, and I'll give business owners a little golden nugget here that they can use to get around that, especially on the FICA tax. Okay. Mm-hmm. And this is actually something that we help out with because a part of our business outside of the CFO work, my partner is a tax guy. He's a tax guru. We do very deep dive tax planning, very, very deep dive. We're about 2 months out on a waiting list right now with clients on our tax planning products, right? We do like probably a 50 slide presentation on your average tax planning presentation, right? Where we're reducing your tax bracket by anywhere from 5 to 10 points, right? So if you're in a 35% tax bracket, we've had clients that we reduce down to 25, 18% at some points, depending on how crafty we can get and how willing, financially viable the client is also. That has to, because it involves putting into certain retirement plans, right? Pension plans, 401ks, a lot of stuff like that. We stumbled across a great tax initiative for clients that we never knew about. We learned about it last year, and now we're using it as part of our tax plan in order to get clients in. Okay, so this is like if they're ever interested in it, this is a huge plus for them, right? So it's wellness programs, right? Wellness programs are a huge tax initiative that a lot of people don't know about. And like I said, I stumbled upon it when I was through an alliance member that I did business with that gave me kind of like, we went back and forth. And I asked him what he was into. And he said, I'm selling these wellness plans for this company that I work for now. It was called EHP out in Florida. And he started explaining to me, and I started going down the rabbit hole with him. I said, tell me a little bit more about it. And because he's selling to accountants. And I said, why are you selling to accountants? He said, it's a huge tax write-off. I said, you don't pay FICA tax on this, okay? I said, you're kidding me. So they said, so basically what the government came out and said was they want employers to keep their employees healthy, right? So as an initiative, they want employers that employ more than 25 to 50 employees. If you have that type of payroll and they're full-time employees, they want you to give them a wellness program, which is preventative health measures, right? So what a wellness plan consists of is it comes with preventative health, right? So it will give you like mental health counseling, substance abuse counseling, just to name things a few, medical concierge, right? So like stuff like, say if you go into the doctor and you come down with like, say, cancer, God forbid, or something tragic, right? And you don't know the right questions to ask your doctor or have an intermediary there. They'll provide one with you via Zoom or someone physically with you to ask all the right questions, right? And they give you all these preventative health tests. They give you free gym membership if you smoke, that type of stuff. Because what happens in turns is that the government says that if we have more healthy people, that lowers the cost for insurance companies, and in turn lowers costs for Medicaid, all this other stuff. So they found that, okay, we'll reward you by doing this if you put in this incentive. So with the wellness plan, right, if you have 50 more employees, right, on that FICA tax, on the 7.75 or whatever they're paying on it, you're not paying any FICA tax on there, okay? And what it ends up doing is on the wellness plan. So we've implemented now, I want to say 13 so far. We've done 13 because they take a little bit of time. It takes about a month for each one that you do. But we've done 13 wellness plans. The average wellness plan savings on per employee per paycheck, okay, what it ends up being around a round number for the year, I would say that physical therapist, we put him in one. He ended up saving $230,000, okay, on his payroll. That it lowered his, because he wasn't paying the FICA tax, that it lowered his payroll tremendously, $230,000 at the end of the year. What does that do in turn? It lowered his workers' comp also, right? Because his workers' comp is connected to payroll. So now you lowered your FICA, you lowered your payroll, workers' comp gets affected, general liability gets affected. It was a huge tax write-off that so many business owners don't know about. Listen, I wish I can get out there and market it more and stuff like that, because it feels like I have something, I have gold here. I want to give it to everybody, like, come get it, but I just haven't had the time. So this is the time where I'm reminded of it, to let your viewers know, because it's a huge tax advantage. So if they ever want any information or you guys ever need anything, feel free to help out.
Yeah, that's an interesting one. And it benefits the business owner too, right? Like they obviously do not want their employees to be sick. They want them healthy. And
yes, it does. And that's the other thing too. It's a great, employee retention, it's a great offering to give employees that, when you work here now, you get a wellness program and free gym membership and all these other great things. So
yeah, that's a huge perk.
Yeah.
Okay. All right, Sonny. Well, we've covered kind of a lot of really good tips and tricks and things that the business owner should think about if they haven't been looking at their financials. But is there any other last piece of advice or things that you see that you'd really like to, hit home to anybody that's listening today?
No, I'll just tell you, if you want to get in touch with me, obviously you can go to precisionaccountingconsulting.com, one word, right? precisionaccountingconsulting.com. Our phone number is 631-349-1661, okay? Or you can schedule a free consultation on the website. If you need, like I said, any type of accounting, outsourced CFO role, tax planning, or job costing. If you're in the construction industry, feel free to reach out. And we also have a podcast of our own. It's a year old now, but we're going to get back into the second season. It's called The Profit Principle. It's really valuable. It's on Spotify, YouTube, and Apple podcasts, where we give a lot of tax and accounting tips for business owners, and where we also interview business owners and go over the accounting with them also.
Okay. Awesome. Well, thank you, Sonny. It was a pleasure having you today, and I'm sure I'll talk to you soon.
Thank you so much. It was a pleasure.